Congratulations. You made it to the last section for Module 5. We're going to take a deeper dive into expenses. And the final conversation, the final slide, we'll talk about some of the analysis that you're going to need for your final project. We'll have more description. We'll be talking about more data that you will be gathering and what you'll be analyzing. But you want to stay tuned, or you can probably jump to it at the end if you really want to right now. But I'd encourage you to listen about discontinued operations, going through an R&D, research and development, and some of the other things that you bump into, some of the terminology on an income statement that you want to be aware of. So let's take a closer look and go into our operating expenses, and we talk about discontinued operations. So as we analyze what we deduction from income, we have our cost of goods sold or cost of sales. This is all part of operations. Selling, informational, and administrative expense, or selling general and administrative expense. Anything of the expense, SG&A, as it's mentioned here as well. Number of general overhead items, depreciation items, salaries, marketing, accounting, other transactions. And then R&D. We mentioned research and development is not capitalized, it's not thrown in the asset section of the balance sheet, but almost always R&D is shown as expense. And then we have amortization of intangibles, the intangible assets that show up as a non-cash expense, similar to depreciation. So other deductions from income. This is what we'll call below the line. The other was from income from operations. And then we have restructuring charges. These are one-shots, and actually they happen more regularly than you might think. But the cost to restructure, to reorganize, that are associated are included and listed as a separate line item. Provision for taxes, federal and state. Don't forget you have both in most states. Authority as well as income taxes levied by foreign governments, so international taxes. This is not a tax course, so we are definitely not diving into that one. Discontinued operations. So the businesses that we are no longer going to be in, we can't keep in operations because they're no longer part of our operations. We're divesting of them, so we have a profit or loss from the operation as well as the actual sale. Usually recorded net of tax, so it's net of tax effects. And income attributable non-controlling interest. This is kind of important. So a portion of the subsidiary's income that is owned by non-controlling shareholders, that is a portion not attributable to those that are common stockholders. Okay, so there's the controlling interest is a publicly traded side of things. So how about R&D expense? Anything that relates to research and development becomes part of that expense. You say salaries and benefits. Okay, that makes sense. Supplies. Well, that's consumed in a year. We do that anyways for most expense. License fees for intellectual property or software. Ooh, that can be of more than a year, longer term stuff. Third-party payments and collaboration. Laboratory and other equipment. So if I'm buying equipment, I'm expensing the equipment right away, and the short answer is yes. And how about property and buildings? If it's purely for the research side of the house, property and buildings are also expensed right away. You say, no, I don't feel comfortable with that. I know land doesn't get depreciated, but my buildings sure do, right? And R&D, no, they actually get expensed right away. If they're general purpose property, plant, and equipment, they are capitalized, which means if they are used for other things, if they're not going to be used exclusively for R&D, yes, we depreciate. You might feel better about that one, but the reality is a lot of things are expensed right away. And then we look at R&D as a percentage of revenue. Okay, so we're doing this vertical analysis. Net income is a percentage, gross profit percentage, SG&A percentage. R&D percentage is also a vertical analysis divided by net revenues, which is what you see in the income statement. Naturally, the high-tech firms are having higher R&D, semiconductors, pharmaceuticals, biotech. On the lower side is machinery, equipment, and chemicals. Those are pretty basic businesses that they're not doing a lot of research, although chemistry, they're obviously going to do some, and all businesses do some. Software and services is more in the middle. So those are things that R&D, where we need to put and be aware. So why are we doing all these numbers and analyses? Well, you might say, I like to invest in companies that put a lot of money in R&D because they're going to be paying off in the future. Or maybe I'm analyzing because these companies are putting too much into R&D and they're taking away from my returns in the current. So you look at that and say, well, who's got high R&D expenditures? And you compare companies in the industry. So here's a big pharma. And you're looking at a range from in 2018 from 22.8% down to 12.3%. That's a pretty wide range, And when you look at that saying, okay, well, the Bayer aspirin folks, maybe they've got a lower range or GlaxoSmithKline are at the lower end of the range, but you have Merck and Eli Lilly at the higher end of the range. And they may be doing more research and you might be confident and want to go with companies that do more R&D. So these are forward-looking predictions. You're trying to predict the pipeline. You're trying to predict future products available and future returns that go with that. So we have a provision for taxes. By the way, things got blown out of the water in 2017. Lease adjustments, the lease rules changed, which we didn't talk much about, but they have to capitalize leases instead of just throwing them on the income statement. They have to go on the balance sheet. But the Tax Cut Act dropping to 21% from 35%. Major impact on companies, and both positive and negative. Some had lost carry forward, some had adjustments, expecting gains or profit, whatever it was. They went both ways in terms of adjustments. So if you're looking back at 2017, 2018, you might be seeing some jumps. And if you look at the line items, that's how you analyze. You say, okay, my SG&A changed, my gross profit percentage changed, my cost of goods sold changed, my net income percentage. But if you look at the tax change as a percentage of total revenues, total sales, you might see the impact. And that's one of the analyses. You say, okay, what are the big tickets? What really changed? Well, my tax changed from 30 to 20 to or 20 to 10 or whatever it might be. That's a pretty significant element of your income statement. Provision for income taxes, average tax rates are not predictive of future tax rates, and they're projecting a 60% tax rate for 2019 and beyond. You say, wait a minute, I thought the corporate tax rate was 21%. Well, they're projecting a 16% tax rate for whatever reasons, and yep, the footnotes will help tell you the story. Let's talk about discontinued operations. So I have income from discontinued net of tax and gain or loss on disposal of operations net of tax. Again, this is below the line. This is stuff outside of operations because these are no longer part of your operations. So we can't include them above the line. So the company has to report continuing operations versus discontinued. Net of tax is what everybody's reported. So why do we separate discontinued operations? Well, we just said that. It's transitory. It's temporary. It's the one shot and no longer going to see it. We got rid of the division, so it has no real impact on predicting future performance. Yeah, we might have made a lot of money that we can invest elsewhere, but the reality is the revenues and the expenses associated with that division are not showing up in the income statement directly anymore. Investors tend to focus on income from continuing operations because that's the level of profitability that is likely to persist, which is why operating cash flows are a better predictor of future cash flows than are investing or financing. And to be classified as a discontinued operation, strategic shift for the company, okay, and a major effect on the financials. Materiality still kicks in. If it's, if we just sold off a building, that doesn't really affect. If we sold off a division that we don't make much money for, we're a multi-billion-dollar company and we got a couple $100,000 or $1 million, not a big deal. Then we have pro forma recording. Let me ask you a quick question. Can you have 5 different sets of books at a company and be legal? Just think about that. Can we maintain 5 different sets of books and be legal? Well, the short answer is yes. What do you mean, yes? Well, we can have a set of books for taxes, which is not GAAP. We can have a GAAP set of books. If you go into the bank for a loan, you might have a fair market value set of books. You might have a couple of other assumptions that you made that are not GAAP, but you want to record those on your books. And here we have pro forma or non-GAAP income reporting. Okay, management believes provide a better measure of the financial performance for whatever reason. The SEC requires you to reconcile non-GAAP to GAAP information, but you need to be able to understand the differences because we all expect the GAAP standard when we read financials. And if it's not going to be along with the GAAP standard, something called Regulation G, that's for GAAP, we have to reconcile from non-GAAP to GAAP numbers. Pro formas, yep, we got our footnotes that are our friends, and it talks about how they are reflecting operational growth, fourth quarter revenues. They might be making some projections, including them in revenues, and that's not GAAP until we can't recognize those things. Things were return, losses, gains, whatever it might be. And then there's something called the adjusted diluted earnings per share. There's earnings per share. There's a diluted earnings per share. And then Pfizer decides to throw in an adjusted diluted earnings per share, which is not GAAP. So that's okay. They don't have to have everything in GAAP, but they need to report what's not. And some more SEC warnings. With appropriate sound warning the public. We have methodologies other than GAAP. And even if you're IFRS and you're trying to report, the SEC requires GAAP. And the opportunities for national companies to report on GAAP, they have some options to report IFRS, but you might have your own IFRS set of books because you report in other countries as well. So we do need to read the footnotes and to make sense. And as promised, the final slide for this module. Let's talk about this for a minute. We are analyzing companies. We're making decisions based on analysis, whether to invest, whether to do business with. I mean, there's nothing wrong with a vendor or a customer getting a financial statement. A customer might want your financial statement to say, oh, you've got a 5-year warranty. Are you going to be including in the 5-year warranty? Are you going to be around in 5 years to honor the warranty? A vendor might want your financials to say, how much credit can I extend to you? They want to get paid back. They want to look at your financials and see what your financial strengths and weaknesses might be. That will determine how much of a line of credit or how much they will allow you to go to purchase on credit. So how are we going to do this? Well, we're going to go through a series of steps, make analyses, start by reading the annual report and the audit report, or I'm sorry, reading contents of the annual report. The auditor's opinion letter, the R's report will be part of your analysis, and note any deviation from boilerplates. We're going to look at the accounting policies, and usually note 1, as we demonstrated last Wednesday evening, note 1 is the accounting policies for all kinds of line items on your financial statements. We're going to look at changes in those accounting policies year to year. So if we change a method of how we interpret things, LIFO to FIFO inventory, last in first out to first in first out, it's going to have an effect on your financial statements, both the balance sheet and the income statement. But you want to know those changes happened and you need to watch for them. Compare key ratios. We're going to do a bunch of ratio analysis. You've already started doing ratio analysis, and you're getting a feel for how ratios are calculated. We're going to review competitors' ratios. So not just our companies. We're going to look at our companies over time. We're going to look at last year's, previous years. But we're also going to look at competitors in the same time frames and see how they accomplished what they were doing. Then we're going to have non-recurring items to separately assess their impact, and things that are one-shot deals that, again, are usually below the line is where you see them. And we may be needing to recast or readjust. We're not going to probably do this in this class, but when competitors make changes, we might need to adjust to be comparable, and those for comparability so that things are relevant and effective in understanding how things are performed. So this is the big picture of financial analysis of what we're doing and what we've been learning and what direction we're headed. Look forward to future interactions. I'm going to go ahead and sign off. I appreciate your time, your commitment, and we look forward to continuing to learn, share, and grow together. Thank you.